Welcome to the Deep Dive, where we try to cut through the noise on stories really reshaping our world. Today, we're jumping into, well, a truly dramatic chapter where high-tech corporate drama meets global power shifts. We're talking Intel, the U.S. government, and a pretty bold, unprecedented attempt to reshape the entire semiconductor industry. Before we get into that, though, just a quick note for those of you who love those big historical narratives. We often mention Hui Wang's A History of China series. Well, the newest volume is out now. It covers Genghis Khan. You can find it on Amazon, ebook, and paperback. Just, an amazing journey if you're curious about that part of history. Okay, so back to Intel. August 2025. It really stands out as maybe one of the most turbulent months in the company's whole history. It basically kicked off with President Trump very publicly accusing Intel CEO at the time, Chen Liwu, of a, quote, conflict of interest and actually demanding his resignation.
Yeah, a very direct, very public challenge.
Right. But then just days later, the whole narrative just flips completely. Trump meets Chen at the White House, praises his amazing success, and then boom, the even bigger bombshell. The U.S. government says it's going to acquire a huge 10% stake in Intel.
Making it the largest shareholder, potentially.
Exactly. And crucially, the money for this, it wasn't new spending. It actually came from grants already earmarked under the CHIPS Act, but not yet handed over.
Right, unallocated funds.
So our mission today is really to unpack these kind of dizzying events. We need to understand the long, sometimes painful story of Intel's decline from the top, and then try to analyze the really big strategic motives behind Washington stepping in like this, because this wasn't just about, saving a company. It felt much bigger.
It was definitely about national priorities, yeah.
Okay, let's start with that month then, August 2025, that initial fiery outburst on August 7th. President Trump uses social media, doesn't mince words, accuses CEO Chen Liwu conflict of interest, demands he resigns. What exactly sparked that?
Well, what's really fascinating here is the background that kind of fueled that accusation. Chen Liwu, he's a Malaysian-born American investor. He'd really made his name founding Walden International, which is a venture capital firm.
Okay.
And Walden International had a history of, well, pretty significant investments in Chinese chip companies, including a big stake in SMIC.
SMIC being Semiconductor Manufacturing International Corporation, China's biggest chip maker.
Exactly.
Yeah.
And Chen himself had actually been a director at SMIC until 2018. So those links were there.
So those Chinese investments were obviously a major red flag for the administration. But was it just that, or were there other things in Chen's past that fed this whole conflict of interest claim?
It wasn't just the venture capital side, though that was significant. Chen had also been the CEO of Cadence Design Systems from 2009 to 2021.
Right. Cadence, big player in chip design software.
A huge player. And during his time there, Cadence sold essential chip design software and even some hardware to various Chinese tech firms. Now, this eventually led to a pretty hefty fine, $140 million from the U.S. Commerce Department. That was in July 2025, so just before this all blew up.
Ah, the timing.
Exactly. And you also had Senator Tom Cotton, who had already been very critical of Chen's appointment to Intel's board earlier. So you put together those existing connections, the recent fine. It gave Trump very public, very immediate fuel for that attack. And actually, the securities research firm Bernstein, they even flagged concerns about Chen's background, noting he didn't seem to have any personal ties to the Trump administration, which they thought might make things difficult if this conflict issue was pushed.
Right. But then just 4 days later, like you said, the whole thing turns on a dime. It was whiplash, really.
Right.
What happened at that White House meeting on August 11th?
It really was a complete and, frankly, surprising turnaround. After that meeting at the White House, Chen was there. Trump, Treasury Secretary Bessent, Commerce Secretary Lutnick, too, the public tone just completely shifted. Trump came out praising Chen's, quote, amazing success and rise, said he wanted more communication.
Wow. From demanding resignation to praising his rise.
Exactly. And the market, reacted instantly. Intel stock jumped 3% just on that news.
Yeah.
It went from public condemnation to public praise, seemingly overnight.
And the government's big move didn't end with just praise. August 22nd, the Wall Street Journal breaks the story. The U.S. government plans to buy 10% of Intel. Wants to be the biggest shareholder.
That must have sent shockwaves. I remember SoftBank jumped in quickly too, right?
Yeah, Japan SoftBank Group followed up almost immediately with a $2 billion investment into Intel. They clearly saw which way the wind was blowing. A strategic play was unfolding.
And then Trump himself confirms it after another meeting with Chen, saying the deal was, quote, initially agreed upon. So what were the nuts and bolts of this government buy-in? It's pretty unprecedented. The specifics really reveal the government's thinking. The Commerce Department agreed to buy 433 million shares of Intel stock at $20.47 per share. That totals up to about $8.9 billion. And importantly, that represents exactly 10% of Intel's total stock at the time.
Okay, but the money. You mentioned it wasn't new spending. Where did $8.9 billion suddenly come from?
Right, that's the crucial part for understanding the mechanism. This $8.9 billion, it didn't come from some new congressional appropriation. It was sourced directly from those unallocated grants under the CPS and Science Act.
Ah, the CPS Act money. The big fund set up to boost U.S. semiconductor manufacturing. So money that was already sort of promised to Intel for building factories.
Precisely. The Biden administration had initially pledged over $11 billion in grants and loans to Intel for building new U.S. factories. But by August 2025, only about $2.2 billion of that had actually been paid out.
Okay.
So that remaining $8.9 billion, which was already kind of in the pipeline for Intel, was essentially held back by the Trump administration and then converted into this equity stake instead of being given as a grant.
So it was a kind of swap, grants for shares.
Basically, yeah. And the deal offered, well, perceived mutual gains. Intel got the crucial immediate cash infusion it desperately needed, plus really significant political backing, which helped stabilize things. And Washington, for its part, gained what they termed symbolic control of a strategic asset.
Symbolic control. That's an interesting phrase. I mean, becoming the largest shareholder, surely that comes with some real influence, even if they promise not to interfere, or was it truly just a political signal?
That's a really important question. The administration was very explicit. They promised no interference in personnel decisions or board matters, and Chen Liu did remain CEO. So that suggests the primary goal wasn't really about day-to-day operational control. It was more about the powerful statement it sent.
What kind of statement?
That the U.S. government was willing to directly intervene, take a financial stake in what it now saw as critical national infrastructure. It was a politically smart move, too. It gave the U.S. a direct, very visible investment in this vital industry without necessarily getting bogged down in the complexities of actually running the company.
So yeah, much more than just a dry financial transaction. This was really a statement about national priorities, showing how deeply technology and national security have become linked for all of us.
Okay, so to really grasp why Intel, this giant, needed such an extraordinary government intervention, we have to rewind a bit, look at its history, its golden age, and then the decline.
Right.
For decades, Intel was just the king. Can you paint a picture of that dominant era?
Absolutely. Intel's dominance truly shaped the digital age, founded way back in 1968. Co-founder Gordon Moore gave us Moore's Law, of course. Intel really pioneered this vertical integration model. That means they designed and manufactured their chips all in-house. Very few companies did both.
Right. Total control. Total control.
Yeah.
And their strategic alliance with Microsoft, famously called Wintel, combined with their x86 chip architecture. It created this incredibly powerful near monopoly, especially in the PC and later the server markets. From about 1992 all the way to 2018, Intel was the world's largest semiconductor firm by revenue. Just unshakable, it seemed. They were the benchmark.
So the key insight here isn't just that they fell behind later. It's that the very thing that made them so strong for so long, that vertical integration, doing everything themselves, eventually became their weakness.
That's exactly it. What was once their fortress kind of became their prison as the industry evolved around them. The chip industry went through this massive fundamental split. It basically fractured into two camps. You have the fabulous designers, companies like NVIDIA, Qualcomm, AMD, who only design chips and outsource the manufacturing.
Okay.
And then you had the foundry contract manufacturers like TSMC in Taiwan, Samsung in South Korea, who specialize only in the manufacturing process for others.
And Intel tried to keep doing both.
Right. Their do-it-all approach started to struggle. They famously missed the boat on the smartphone revolution, which is dominated by the ARM architecture, not Intel's x86.
And just remind us, why did ARM win out so decisively in mobile?
It really came down to power efficiency. ARM's designs were just much, much better suited for battery-powered devices like phones and tablets. Intel's x86, while powerful for desktops, just consumed too much power for that market early on. And that miss had huge consequences. Intel's PC chip market share fell from around 84% in 2019 down to 69% by 2024. Even worse in servers, from 94% down to 62% in that same time frame. Just a massive slide.
And at the same time, the actual manufacturing of chips got unbelievably complex and expensive. We're talking nanotechnology, right? Almost atomic scale stuff.
Completely. Modern chip manufacturing is incredibly specialized, unbelievably capital intensive. You've got dozens of intricate steps, purification, lithography. That's where those advanced EUV extreme ultraviolet lithography machines come in. A single one of those can cost $400 million.
$400 million for one machine. And they're essential for the cutting edge.
Absolutely essential. EUV is what allows them to etch the microscopic circuits needed for today's most powerful chips. It's just a high-stakes, high-cost game. You need constant innovation because of Moore's law, driving costs up. And yield rates are critical if a new manufacturing process can't reliably produce good chips, say below 70% yield, you're just losing massive amounts of money.
And the supply chain for all this tech became global.
Deeply globalized. The best EUV machines come from ASML in the Netherlands. A lot of the critical R&D materials patents come from Japan, Europe, elsewhere. So Intel's historical culture of internal innovation, trying to own and control everything themselves, just couldn't keep pace with this specialized global network.
Meanwhile, TSMC.
TSMC, Taiwan Semiconductor Manufacturing Company. They took the opposite approach, a pure foundry model. They focused only on being the best manufacturer, pouring all their resources and R&D into process technology innovation.
And it worked.
Boy, did it work. By concentrating their funds and tech, they achieved something close to 90% market share in the production of the most advanced high-end chips. They became the go-to manufacturer.
Leaving Intel. Where?
Leaving Intel struggling badly. Their revenues cratered. Nearly $80 billion in 2021, down to $53.1 billion by 2024. And they weren't just making less money, they were losing it. A staggering net loss of $19.2 billion reported for 2024. So Intel, the former Titan, had become, as one analyst aptly put it, the drowning man of the chip industry.
The drowning man. That's quite an image for a company that basically built the modern computing era. It's stark. Now, facing this crisis, Intel didn't just stand still, they did try to reform. Pat Gelsinger came back as CEO in 2021, an Intel veteran, with a really ambitious turnaround plan.
He did. Gelsinger launched a pretty drastic reform. The core idea was to split Intel's own design teams from its manufacturing operations, effectively turning the manufacturing part into a major foundry business. The goal was huge, become the world's #2 foundry, behind TSMC, aiming for 30% market share by 2030. It was a direct challenge, a total strategic shift.
But that kind of transformation, building huge new factories, competing with TSMC, that takes serious money. You mentioned $100 billion over 5 years. Where was that supposed to come from, given their losses?
That was precisely the Achilles heel of the plan. Gelsinger estimated it needed at least $100 billion in capital expenditure over 5 years, a massive sum. Intel only managed to secure about $11 billion in external financing from Apollo Global Management. And the CHIPS Act grants, while promised, were slow coming and just not nearly enough for that kind of investment scale needed to truly catch up to TSMC or Samsung.
And it wasn't just the manufacturing side struggling. Their efforts in chip design, particularly for the crucial AI market, they weren't paying off either, were they?
No, that was another major challenge. Their big hope for AI, the Gaudi 3 chip, its sales were less than $500 million in 2024.
Which sounds like a lot until you compare it.
Until you compare it to NVIDIA, who is just raking in around $20 billion per quarter from their AI chips.
$20 billion a quarter?
Yeah. And NVIDIA didn't just have superior hardware at that point. They had built this entire software ecosystem around it, the CUD platform. Developers were logged in, clients could customize things easily. Intel was fighting battles on multiple fronts, trying to catch up on the hardware, build a competing software ecosystem from scratch, and attract top AI talent in a market where NVIDIA was the undisputed leader. It was a huge uphill climb.
And the manufacturing hurdles just kept piling up. You mentioned U.S. costs being higher.
Definitely a factor. Manufacturing chips in the U.S. was estimated to be 20%, maybe even more expensive than doing it in Asia. Plus, potential external foundry customers, the fabless companies, they overwhelmingly preferred TSMC. Why? Because TSMC had the proven track record, the scale, lower costs, and frankly, these companies were already deeply integrated into TSMC's processes.
So Intel built these new foundry capabilities, but struggled to get customers.
They really did. In the first half of 2024, only about 1% of Intel's foundry revenue actually came from external clients. Almost all of it was still just manufacturing their own internal designs.
Wow. So all these factors combined.
It led to a cascade of problems, mounting debt hitting nearly $87 billion, around 15,000 layoffs. They had to suspend their dividend payments to conserve cash. The stock price dropped 30% during this period. Morale must have been terrible. And eventually it led to Pat Gelsinger resigning in 2024.
So Chen-Li Wu, despite that initial storm around his appointment, he inherited this absolute mess.
An incredibly difficult situation. You had Qualcomm, the mobile chip giant, reportedly sniffing around, interested in buying Intel's valuable chip design division.
But not the factories.
Pointedly not the expensive, underperforming manufacturing arm. That tells you a lot. Chen had to make tough calls immediately. He paused major construction projects like the ones planned in Europe and the big one in Ohio, basically delaying completion beyond 2030 just to stop the bleeding, to conserve resources.
That Ohio factory was supposed to be state-of-the-art, right? Billions invested.
A $28 billion project planned for Intel's most advanced processes. Putting that on hold was a huge sign of how dire things were.
It really does raise that question again. How does a company that basically defined the digital age end up here, needing a government lifeline just to, well, tread water? It's a stark lesson in disruption.
Okay, so Intel is fragile. Gelsinger's plan hasn't worked. Chen is trying to stabilize things. And this is the moment the Trump administration steps in with that equity stake. It starts to become clear then that Washington's real goal wasn't just about saving Intel Inc., the whole company. It was much more targeted.
You're absolutely right. The administration's core focus, the strategic imperative, was securing Intel's foundry business, its ability to manufacture advanced chips on U.S. soil. It was fundamentally a geopolitical calculation. There were reports, for instance, that Trump was actively considering, let's say, guiding major American chip designers like AMD and NVIDIA to place manufacturing orders with Intel's fabs.
Using government leverage to fill Intel's factories.
Potentially. And significantly, the Commerce Department even offered to buy an additional 5% stake, but specifically in a future, potentially independent Intel foundry business. That really signals the long-term commitment wasn't to Intel's design side, but specifically to building up U.S.-based manufacturing capacity.
So the deeper insight here is really that semiconductors have transitioned from being just, components in our gadgets to something much more fundamental like oil or electricity.
That's a perfect analogy. They're the new strategic oil.
Mm-hmm.
And for the U.S. government, particularly under Trump's America First lens, the heavy reliance on TSMC became a critical vulnerability.
Why the intense focus on Intel's foundries, though, especially when TSMC itself was building new plants in Arizona?
That's the key geopolitical concern. It's a concentration risk. Despite its global footprint, TSMC still produces about 2/3 of its most advanced, cutting-edge chips right there in Taiwan.
Which is obviously a geopolitical hotspot.
Exactly. And even with TSMC investing a massive $165 billion in those 6 new fabs planned for Arizona, the projections showed that even by 2030, the total manufacturing capacity in Arizona would still be less than 1/3 of TSMC's overall capacity. And maybe more importantly, the technology node, the sophistication of the chips made in Arizona, was expected to be about a generation behind what TSMC would be producing simultaneously in Taiwan.
So still reliant on Taiwan for the absolute cutting edge.
Precisely. So for the Trump administration, ensuring a robust, leading-edge chip manufacturing capability physically located in the U.S. became a matter of national security, absolutely critical. It was about preventing potential disruptions to vital sectors, defense, drones, AI development, even advanced automotive manufacturing, all increasingly dependent on these high-end chips. Semiconductors weren't just technology anymore. They were undeniably strategic infrastructure.
And looking beyond that core national security argument, these big factory projects like the one in Ohio, they also offer significant economic and political upsides, don't they?
Oh, absolutely. Building massive new fabs like the planned Ohio complex means thousands of construction jobs, then thousands of high-paying permanent jobs. It generates significant tax revenue for states and localities. Plus, it helps build out the whole ecosystem, training engineers and technicians for an industry that faces serious talent shortages right here in the U.S.
And politically.
Politically, it's a winner. Backing major domestic manufacturing projects, especially in crucial swing states like Ohio, provides clear electoral advantages. It fits perfectly with a reshoring, made-in-America narrative that resonates strongly with many voters. It aligns strategy with politics.
Okay, zooming out one last time. While this government intervention, this equity stake, is a really powerful signal and provides crucial funds, chipmaking is still fundamentally global. There are challenges that even this bold move doesn't just magically solve, right?
Absolutely, that's a critical point. Despite this push for domestic production, the semiconductor ecosystem remains deeply interconnected globally. You still rely on patents from companies worldwide, specialized manufacturing equipment primarily from Europe and Japan, essential raw materials often processed in Asia.
So things like tariffs or aggressive export controls could backfire.
There's definitely a risk. Policies like very high tariffs, broad export restrictions, or too much direct political interference. They could potentially disrupt the complex global supply chains more than they help. They could destabilize the very high-tech market they're trying to secure, maybe raise costs or slow innovation.
And the core funding issue for Intel's huge ambitions.
That remains a question mark. The grants for shares deal was a lifeline. It plugged an immediate hole. But Intel's fundamental funding gap for that $100 billion transformation Gelsinger envisioned, that hasn't gone away. We saw that the original CAMP-PS Act funding under the Biden administration, while significant, wasn't enough on its own to fully revive Intel's manufacturing to the level needed to seriously challenge TSMC. So it suggests that Trump's equity purchase, while dramatic, might also end up being more of a temporary Band-Aid than a complete permanent fix for Intel's deep-seated competitive and financial challenges in manufacturing.
So it really leaves us wondering, doesn't it? Is this the dawn of a new era of hands-on industrial policy for strategic sectors? Or is this kind of equity stake ultimately just a stopgap measure for a company facing enormous global headwinds? It's clear, though, Intel's story is this incredible saga of dominance, decline, attempted reinvention, and now this dramatic collision of geopolitics and raw economics. So just to recap, we've traced Intel's path from the undisputed king of chips through its struggles to adapt to a changing industry, Pat Gelsinger's ambitious but ultimately unsuccessful reform efforts, and finally this unprecedented moment where the U.S. government stepped in not just with grants, but by taking a major ownership stake, driven by national security concerns around semiconductor manufacturing. And as we wrap up, just that reminder again about Hui Wang's A History of China series, with the new volume on Genghis Khan out now on Amazon ebook and paperback, worth checking out if you enjoy these deep historical explorations. But the Intel story really forces us to think about how semiconductors have shifted from being just, a specialized technology component into something truly fundamental strategic infrastructure right at the heart of global power competition. It really makes you consider, what does this transformation mean for national sovereignty going forward, for economic competition, and really for the future shape of the global supply chains that we all depend on? What does it mean for you? Lots to think about there. Thank you for joining us for this deep dive into Intel's pivotal moment and America's evolving semiconductor strategy. We'll be back soon with more stories and analysis.